How large will required minimum distributions grow through time in your retirement? In today's video, we're going to give you a framework that can help you determine just this. Now, for those that don't know, required minimum distributions are a forced distribution that you are set to take from your tax-deferred accounts once you turn age 72. And because of two important factors, RMDs generally grow through time. The only thing that will prevent this growth would either be losses within your tax-deferred account or if you're withdrawing more than your RMD. This is something we call RMD creep, and is something that you need to be acutely aware of. But just how large will your RMD grow through time? This is extremely important as we're building a forward-looking tax plan and trying to estimate what our tax liability will be down the road. So in the majority of retirement plans that we build for clients, we see a phenomenon that looks like this. As you'll see on the screen, this is an income analysis for a given client. And we'll see these green bars on the screen that increase through time. These are your required minimum distributions. We can see just how large of an issue these required minimum distributions will be for this person's situation. They start in what is currently the 22% bracket, are pushed into the 24% bracket pretty quickly as RMDs ramp up, and are even almost pushed into the 32% bracket. What this means for this person's situation is they will see quite a bit of their wealth lost to taxes as they start scaling these brackets. At the end of the day, this is money they don't ultimately want to pull from their accounts, but are being forced by the IRS. Now, as I mentioned in the introduction, there are two factors that cause this RMD creep. The first one is baked into the RMD formula. So you determine your required minimum distribution each year by taking your IRA balance at the end of the previous year and dividing that by an age factor. Now what you'll see is this age factor decreases through time. Now this is the divisor within this equation. So this decreasing through time means you will ultimately have a larger required minimum distribution. Let me show you a specific example here. So we have RMDs at age 72, and this specific retiree has a $1.12 million IRA balance. Now their first starting RMD will be about $41,000. But 10 years later, by the time they reach age 82, without any change within their underlying portfolio balance, they will have a 48% higher RMD. We take the same $1.12 million IRA balance, we now divide that by the current age factor divisor, which is 18.5, and we see their RMD updates to $60,500. So this factor alone will cause you to take slightly more in required minimum distributions each and every year. The second factor you need to consider is growth. Now the starting RMD withdrawal rate is small enough that with a well-diversified portfolio, we expect our portfolio to grow despite having to withdraw that required minimum distribution. For instance, the starting RMD withdrawal rate is 3.64% within the uniform table. By age 80, this rises to almost 5%. By age 90, this rises to 8.2%. And so this RMD withdrawal rate will rise large enough that your tax-deferred accounts can't outpace that withdrawal rate. But for the first 10 to 15 years, we expect most portfolios to outgrow that given withdrawal rate. Thus, we see there's another factor leading to this RMD creep. Now, a big mistake that I often see retirees and other advisors make is not planning for this growth. They look at their starting estimated RMD and expect that RMD to be static through time. But as we talked about, these two factors can really start to grow your RMD. But by how much? On the screen, I have a table that estimates this RMD growth based on three different portfolios, and we're using historical assumptions here. And we're also looking at the growth, assuming that all you are taking from these tax-deferred accounts would be that required minimum distribution. If you are taking more than your RMD, or if you're performing Roth conversions on top of your RMD, obviously this can affect the growth that we expect within that RMD. Now keep in mind within this table, I am showing the multiplier at that given age. So for instance, let's say that you were 72, you had a $10,000 required minimum distribution, and you were investing in an all-stock portfolio. Well, based on historical assumptions, we would expect at age 75 that $10,000 RMD would have increased to $13,300. By age 85, we would expect that $10,000 RMD to increase to $33,500. By age 95, we would expect that $10,000 starting RMD to grow as large as $84,200. Now you can see that in a more diversified 60-40 portfolio, or even an all bond portfolio, these multipliers change quite drastically. For instance, if we started out with a $10,000 RMD at 72 and we were investing in an all bond portfolio, we would expect that RMD to have grown by age 95 to only $20,400. And so the underlying investments within your tax deferred account can really affect this RMD creep. Now, as a side note, this is why it's so important to be focusing on something like asset location when you're in retirement. Asset location means putting the right investments in the right accounts. Generally, this means you want to hold all of the high growth investments within your tax-free Roth accounts, and you want to generally locate most of your safer assets into your tax-deferred account. The reason being is because of RMD minimization. And you can really see this asset location idea come alive when we look at this RMD creep table. Now, keep in mind here that when we talk about how large of a liability those RMDs will be to your retirement, the multipliers that we showed in the previous table will generally stay the same. But the starting size of that RMD can change your tax situation quite drastically. For instance, if you start out with a $20,000 RMD at age 72, we expect in a 60-40 portfolio that to grow to about $56,200 by age 85. That's a completely different situation than if you start out with a $110,000 RMD at age 72. In terms of the liability it would be to your retirement, as it would push you into different tax hurdles, push you into higher and higher tax brackets, we see we're in a completely different ballgame. At age 85, if you were trying to deal with minimizing these RMDs, it would be much more difficult the larger those RMDs are versus the smaller those RMDs are. And so this really puts an emphasis on minimizing RMDs before they start. Now, luckily, most tax brackets adjust for inflation. And so when we look at, let's say, a 13% increase in your RMD from one year to the next, you won't necessarily see a 13% increase on the tax of that RMD because we see the underlying tax brackets should adjust somewhat to inflation as well. And so now when we start to look at this RMD creep in inflation adjusted terms, we'll still see that it's a big issue for most retirements, but certainly not as big of an issue as it would be if we were just looking on a nominal basis. For instance, in a 60-40 portfolio, we would have seen our starting RMD by the time that we reached age 85, we would see a multiplier of 2.81 in the previous example. Well, now in the inflation adjusted example, we would see this only increase by 90%. So in layman's terms, what this would mean, if you started with a $50,000 RMD in today's dollars, that RMD creep would transform that $50,000 RMD to $95,500. Now on the right-hand side of the screen, I took that table with the multipliers that we have on the left-hand side of the screen and translated them to a dollar amount. So we're looking at a starting $50,000 RMD. And now you can start to see how this RMD creep transforms those RMDs in current dollars through time. So for instance, if we start with a $50,000 RMD with an all-stock portfolio, by age 80, we expect that RMD to be $84,000. By age 90, $158,000. Again, in current dollars. With a 60-40 portfolio, we expect a $50,000 RMD to roughly be about $75,000 by age 80 and about $116,000 by age 90. And notice once again with an all bond portfolio or an all safe asset portfolio, if you want to replace bonds with some other safer asset, we see that, well, RMD creep isn't as big of an issue. In inflation adjusted terms, we actually don't see that much growth with a safer portfolio within that tax deferred account. Now, if you're a DIY investor or you're someone that simply wants to run some numbers on their own to double check your advisor's math, or maybe you just want a little bit more insight into your situation, you can take your estimated starting RMD. You can plug that into these given tables, and based on your portfolio allocation within that tax deferred account, you can start to see in current dollars how big of an issue these RMDs will be within your tax situation. Now, here's an example of what this might look like. Now, in the background is a marginal tax graph for a retiree who is currently on Social Security, and this tax graph shouldn't change too drastically as this retiree moves through time. Now, let's say this person has a starting RMD of $50,000, and they're currently invested in a 60-40 portfolio. So we can see with each of these lines on the screen where we expect their RMD to be in inflation adjusted terms as this person ages. We'll see that their starting RMD puts them inside of what we call the Social Security tax torpedo, but luckily not yet to the point where they're taxed at that marginal spike that we see on the screen here. But as they age and as they start to see RMD creep start to have an effect on their situation, we start to see where their RMDs will grow to. At age 80, at age 85, 90, and 95, we see now, because their RMDs have grown large enough, they're pushed completely through the Social Security tax torpedo. They even end up being pushed into some of these Medicare IRMA marks that you see on the screen with the dotted lines. And so when this person was running an estimate for their starting RMD, it didn't seem like it was that big of an issue for their given situation. As they move through time, however, we start to see that the increase of those given required minimum distributions starts to increase their tax liability and causes them to leak taxes from their wealth. What does this all mean? Well, first, you can take the tables within this video and start to use this with your situation, to use that as a rough guide, a rough framework for estimating how large your required minimum distributions will grow through time if you don't do anything to minimize them. But there are always things that you can do, regardless of your age, to minimize RMDs, such as Roth conversions and proper asset location, even if you're already taking RMDs. For instance, in a video right here, I talked through a couple strategies that you can use to minimize RMDs when you're already on RMDs. But nonetheless, you still have options if you're strategic about them. Thanks for watching. Always remember, you don't need more money, you need a better plan.